2 minutes after the top of the hour. And so I think that we will go ahead and kick things off. And so I just want to thank everybody for showing up at this webinar. Of course, we have Barry Habib with us. He's out in New Jersey right now at the NBS Highway. He's going to be showing us some great stuff. We also, of course, have Tom Hutchins with Angel Oak, who's the actual sponsor of the webinar, and he's going to be showing us some stuff. And you've got little old me that's going to be basically kind of facilitating the whole thing. So thank our panelists for being here, and let's go ahead and get started. So we're going to dive right into this, guys. And obviously, the title we've got here is How to Close Deals Despite Higher Interest Rates. And whether you're dealing with, a non-agency borrower or not, we're definitely in a higher interest rate environment. So with that in mind, we're going to definitely want to pay close attention to this webinar and see what you can do here, especially with your non-agency deals, your non-QM deals. And with that in mind, I'm going to go ahead and launch a quick poll for you guys. You should see something pop up on your screen, and where you can go ahead and complete that poll for us real quick. We're just curious to see how many of you are doing some non-agency, non-QM stuff currently. And we do have people, or we're looking at the poll in progress. It's pretty nice. It's so neat how the system works. But it's looking about a 70-30, 30% yes, 70% no, which is really great for this webinar, because I think for those of you who haven't done an agency or non-agency deal recently, you're going to realize that, oh my gosh, there's a huge market here that I can tap into. And with the help of Barry and understanding how I can help encourage my potential borrowers who might be looking at a little bit higher rate initially to go ahead and go through with the transaction, I think this is going to be a real benefit for all of you guys to take this webinar. So it's looking like, guys, just so you know, Barry and Tom, it's right there at like 30-70. 30% have done a non-agency deal in the past 12 months, 70% have not. So there you have it. So I'm going to go ahead and close that poll. With that, I want to kind of turn this over to Barry and let Barry just kind of talk to us a little bit about the current rate environment and what he's kind of gonna want to make us think about here before we dive into this full-on webinar, where we're actually going to look at higher rate scenarios and how to combat them for you guys. So Barry, take it away, my friend.
Well, I am very, very excited about talking about the opportunity that exists right now, even though rates are a little bit higher, because really this gives you a chance to outshine your competition. And look, from the way that I've studied sales, people will make the decision to want to move forward pretty rapidly in the first 5 minutes. So it depends on how well scripted you are in those first 5 minutes. And if you're able to impress upon them that you're an expert, I mean, really an advisor as opposed to a salesperson. I know everybody says they're an advisor, but it takes more than just being able to put a loan together or read a tax return to be an advisor. If you're truly an advisor, they'll be very forgiving towards rates. And, Frank, we've talked about this in the past. Rates, although they seem a little higher right now, the average rate on a 30-year fix for the last 45 years is 8.25%. So rates approaching 5-ish% are not that bad. They're still very, very good. What we saw in the past was kind of an anomaly. We're going to see rates start to move up a little bit even from here. They're going to vacillate a little bit. They're probably going to move up a little bit from here. That puts a little bit of a headwind on the housing environment, but not anything near what would really slow it down. You're going to still see very strong appreciation, and that's really what the focus has to be. When we talk about being an advisor, take the focus off the small difference in rate and put it on the opportunity that you're going to receive by purchasing this home long-term and being able to evaluate that correctly. And I know we're going to go over that within the body of the call today. So just to preface that, I think that we should be prepared for a little bit higher rates, predominantly due to the fact that the Fed's been buying less. And Frank, we've talked about this over and over, and sure enough, do you remember the level that you and I had talked about, 3.04% on the 10-year? We talked about that number when it was down at 2.18. We said, hey, it's going to hit 3.04% in early 2018. And what did we hit? I think it was 3.058%. So close enough to 3.038%. It was close enough to 3.04, almost an exact bullseye. And we backed off from there. If Rates on the 10-year break that, and I think eventually it will. Look for them to go to 3.35 and then maybe 3.85. So we could be in for a little bit higher rates, but the focus has to be on the purchase side, like you've always been preaching, Frank.
Awesome. Well, one thing that we want to do today, guys, is, of course, we're going to see actual genuine examples on how to overcome higher rate objections. But I also want to emphasize with this call that we really want to focus also on being able to find other deals to get them into your pipeline. And one of the best ways we can do that, guys, is definitely by paying close attention to the Angel Oak products that we're going to go through here. We're going to go through a few different scenarios. Scenarios where a borrower was unable to get a home using traditional QM loans or government loans, but Angel Oak was able to help the borrowers out and get them into the property. And so keep in mind, guys, that by making use of the Angel Oak products, you're going to open up a market for yourselves that you might not be tapping into right now. And clearly 70% of us, based on the poll, are not tapping into it. And so you're going to want to pay attention to not only how to overcome these rate objections, but I want you to pay attention to also the products that Tom is utilizing here in these scenarios to illustrate what they were able to do for borrowers that normally would not be able to have gotten something done. So one thing I'm going to want you guys to do as well, before we hand this over to Tom for our first scenario, is I want you guys to make sure you have access to the questions box on your screen where you can ask questions. Ask questions as we go through. We will touch base on those questions right at the end of the webinar. We'll answer as many as we can. However, keep in mind time's a little limited for us here, and if we don't get to all of them, don't worry, because Angel Oak is going to get all of those questions, and they will have their account executives reach out to you to answer those questions for you directly. The other thing that I would like you to do is that.
Or by the way, Frank, I want to just add to that, or if they have questions for me and we don't get to them, I'll get to them. You guys will send me on.
Thank you, Barry. Thank you, Barry. Yes, I'm sorry, guys. Yes, for Barry as well, because he's going to be demonstrating his product, which I know you guys may have questions. Someone from his team will call you as well. Darn it, I lost my train of thought there.
Sorry, Frank.
That's okay. No, it's okay. So anyway, oh no, this is what I wanted to say. So I would also like guys just to do this as we're going through these scenarios, and you're going, gosh darn it, I do need to get connected to Angel Oak. If you just type into the questions box, just connect me or call me, then one of the account reps from Angel Oak will reach out to you to help get you guys set up with Angel Oak, so you can get signed up so you can start offering these products where they have a lot of marketing materials for you as well. So,
and Frank, if I may just add as well before Tom starts here. So I mean, Tom knows I'm a big fan of his and what Angel Oak does. But listen, if you're looking for additional ways to gain referral sources, which is really important right now, and of course more transactions that you'll do, this is a great call for you to listen to, because not only, as Frank said, will you open up a different market, but this will really endear you to real estate agents who feel that they might not have a way to get that transaction done. It also puts you in a position, of course, to make more money that way and build more relationships and endear yourself to the listing agent. But in the back of your mind, you might be saying, you know what, there are some obstacles that I might come across, and let's talk about that. What might they be? If you're talking about an alternative source here, the back of your mind, you're saying, well, does that mean it's going to cost a lot more? Listen carefully to what we're going to be talking about here, because we're going to explain to you exactly how to overcome that objection. And that objection, yes, it applies here, but it's going to apply to any scenario where either rates have moved up or someone's beating you with a little bit more attractive interest rate, even in a conventional scenario. So please listen carefully to what we're going to be talking about here, because I think this can make a very, very lasting impression in your business. And after all, what this is all about here, I've been a professional speaker for over 25 years, and people ask me all the time, okay, Barry, okay, so what's the best thing I could do? What's the one, what the one thing you could do, the best thing you could do to make a lot more money is convert more conversations into applications, convert more discussions with referral sources into actual transactions. Look, you can buy leads, you could spend to manage leads, but you really should focus on conversion. And that's what this call is about today, is how to convert.
Awesome. Thank you, Barry. So with that, Tom, I'm going to hand this over to you. You've already got the control of the screen, but I'd like you to just a real quick introduction and then go ahead and let's dive into the first scenario. So take it away, Tom.
Sure, you bet. So as you said, my name's Tom Hutchins. I'm with Angel Oak Mortgage Solutions. We've been at this for about 5 years, even before QM designations became official in January of 2014. But, what I love about this call is that, as Barry and you both pointed out, we're talking about two things. We're talking about products, programs. You said earlier, 70% of people have not really done a non-QM, non-agency loan. But then the selling part, how do you convert these? So this is kind of a 2-for-1 webinar, which I think is awesome. So with that, I'll kind of just jump into it, and I know Barry and I are going to kind of share some info and some data for everybody on the call. So thanks for joining us, and let's just get into it. And just to preface a couple things. One is we're going to send this out to everybody who's on this call, so you don't have to frantically be taking notes or anything like that. But we'll get you a recorded copy of the call and the presentation itself. But understand that the non-QM is not what you might think it is, especially if you've not closed a loan. I really understand that non-QM doesn't mean the 2005 subprime. Non-QM does not fit that agency or government box of today, which we know is a pretty tight box. And so the scenarios we're going to show you, just a few of them, but these are real loans. These aren't just made up. These are loans of real borrowers. We've hidden the names to protect the innocent and that kind of thing, but these are real deals, and these are the kind of loans that you talk about tools. These are the loans that you really need to keep your eyes and ears open for, because they are everywhere. They're all around you. You just need to find them. So we'll start with the first one. Self-employed borrower, a very common.
What's the location on this one, by the way?
Let's see. This one was in your backyard, Barry, somewhere in like Hudson County, maybe.
You got it, Hudson County, New Jersey. Okay, great.
There you go. So we've got a self-employed borrower. Self-employed borrower whose tax returns don't show enough income to qualify for a jumbo loan. And my guess is a lot of originators that are on this call are familiar with this scenario. So the self-employed borrower comes in and says, I make X, and you go down the road, and then all of a sudden you get those tax returns and they don't make X, they make X minus Y, which equals Z. So one of the advantages of being a self-employed individual, as a lot of us know, is for accounting purposes and tax write-offs. So this was a scenario. We had a borrower whose tax returns would not qualify them for a $525,000 loan amount, but we have a product that was able to get them into that house. And I just want to show you, kind of changing screens a little bit here. This is our quick quote tool. There's a couple takeaways from this call, and this is certainly one of them. And I'll show you, we're on our Angel Oak website. Our web address is angeloakms.com, and it's getting there. There we go. And this is our main page, and right from here you would just click quick quote. Sorry, that's a mouthful. So once you get to quick quote, we'll just do test mortgage, put that in, and then you're off to the races. So once you get here, you really just have to enter a little bit of information. Right now you can see in the red there's no product or program available, but as you start answering the questions, things start to appear. So we said in this scenario we had a borrower with a 743 credit score. The loan amount was $525. So you find that bucket. Here's our $450 to $750. The LTV on this transaction was 75%. And our housing history, we're going to say 0 times 30 in the last 12 months. And as soon as you do that, products and programs and options start to pop up. So here you can see our Platinum program. There was one other key on this scenario, was the borrower's income documentation was bank statements. So we'll just say 12 months of personal bank statements for a self-employed borrower. So you click that, and as soon as those few questions have been answered, the scenario pops up. So here's our scenario. We have a platinum, what we refer to as platinum, which doesn't mean anything to people on the phone, but it's just how we can differentiate our products. We ask for a 75% for this borrower. Based on their credit criteria, we can actually do a 90% loan on this transaction with no MI, and the rate is 5.125. So
Hey, can I say something, Tom?
Yeah, please
Can I
do.
say something? So for those of you listening, I want you to make sure you heard that, okay? This is a better rate than anybody's going to get out there when you incorporate the fact that there's no MI on it. 5 1/8 with no MI is better than an A++ loan anywhere else based on today's rate with MI. So understand that not only are you able to have more flexible underwriting, but the rate is actually better when you look at it, the fact that you don't have to pay MI. I'm sorry, Tom. I just felt that was really important that people understand that.
No, that's a great point. So that's scenario number one, and that's that to me is just these are loans that we see all day, every day. There aren't credit issues. It's simply self-employed tax return issues. So I think with that we can turn it over to you, Barry, and you can take it from here.
Okay,
So,
I will hand off the ball to you, Barry, real quick, just so you can show us your screen. And you got it, my friend. Whenever you're ready.
I am ready, and I know that you can see what I've got here. Okay, so look.
Yep.
So there's a few different things that we can do here. So what I tried to do is take this scenario and just very quickly enter it into a buy versus rent comparison that we can do for you. And let me just show you how amazing this tool would be. So, Tom, what if they didn't have a good credit score? Let me ask you that. What would the rate be? Let's get really kind of on the high side. What would it be?
Well, that's pretty easy for me to. When I click back over there, I'll change that for you. So here we go.
Just give me a ballpark here. Let's say, would we potentially be talking about 7%?
Well, yeah. That our average coupon is somewhere in there, high sixes, low sevens, sure.
So let's look. So many of you now, you're on the call. You're saying, "Whoa, 7%! Hold on there a minute. That's how in the world am I going to sell 7%?" Okay. So just remember what Tom first showed you is if you have your thinking cap on, that's a better rate than anybody could get, regardless of how perfect their credit score was. And remember, they couldn't even get that loan done because they wouldn't be able to qualify. Okay. So he found a way to do it, but not just do it cheaper, more effectively, and better. Realtor's going to love you. But what if that customer did not have a good credit score? So now this is a dead deal. Okay. It is not going anywhere. You have a solution, and let's just say you have a solution at 7%. Well, everybody might say, well, I don't want to do that. 7%, that sounds kind of high. So team, listen, 7%, when we start thinking about the objection, please make sure that the objection is not in your own mind, okay? I want you to understand the difference. One of the most important sales lessons that we can learn is don't make the decision for the customer. Don't have it so that the obstacle is you. That should never be the obstacle. So let's go through this. $700,000 purchase price. That's what we were talking about, right? We were talking about a $700,000 purchase price, and we said it was in New Jersey in Hudson County. You can go to any state in the country, by the way, and you can go to any county in the country, but you picked Hudson County, New Jersey. Now, we know the rents in Hudson County, New Jersey would cost $1.97 per square foot. We also know the cost of purchase is $363 a square foot there. So we can calculate how many square feet this home is and what a comparable rent would be. You could always override it. We've got something in there for renter's insurance on this, and we know the national average for rents going up is 4%, but in Hudson County, we know specifically it's 3% per year. So let's go with that. Now, a $700,000 home, a 75 LTV is what we went with at 525. I put in that 7% rate here, Tom, just to kind of show you on a 30-year fixed, $15,000 in closing costs. We already know what the taxes are there, so that's already in there. There's no mortgage insurance. We have something in there for homeowners insurance, probably a little on the high side. And then I'm throwing in something else here, team. I'm going to throw in no homeowners association, but I want to put in repairs. Because if we're really going to make an evaluation for that customer and we really want to be honest, we really have to tell them that if you're going to be renting, you're probably not going to encounter repair costs. But if you're owning, you've got to figure out repairs. So let's put that in there. And then what about the cost to sell? If you're renting, you don't have to sell, but if you're owning, you probably are going to have to hire a realtor. That's 6%. Somebody's going to say, wait a minute, Barry, that's an awful lot of money. 6% on the future value of that home, it's going to be over $1 million. That's $60,000, $70,000. You sure you want to show that? Yeah, we do. Because we want to give an honest evaluation and empower the buyer to make the evaluation, okay? So what I'm trying to show you here, team, is all the negatives. Throw in repairs. Throw in the cost to sell. Throw in a 7% interest rate, okay? So let's make everything the worst. And now, if they think they're going to be there for 10 years, I picked 10 years here because that's the average time, according to the National Association of Realtors, that somebody stays in a home. Again, New Jersey, Hudson County, we know the historical rate of appreciation, but we also know the forecasted rate. And you can either choose historical, you could use forecasted, you could use a custom rate if you'd like. So let's just go with the forecast for now. The last thing we need to know is your tax bracket. Don't worry, we make it easy. If you know what they are, married or single, or a head of household, their combined income, and in this case, if their combined income were, I don't know, $160,000, they're in the 22% tax bracket. And now we need to know how they're filing. If they're single, they have a $12,000 standard deduction, so their tax benefit is going to be much greater. But if they're married filing jointly, their tax deduction will be much less because their standard deduction is much higher. And you'll find for a lot of people, they won't even get a tax deduction. So look, let's take a look at this here. If they were to buy, it'd be $5,200 a month versus renting at $3,800 a month. Somebody might say, hold on a second. It is $1,400 a month cheaper to rent. Are you crazy? I'm going to rent. I'm not going to buy. I'm not going to go with that 7% rate. Listen, that's one part of the equation, and that's where most people stop. It's your job as an advisor. Those of you listening, a real advisor does the analysis and says, hey, wait a minute. We know in Hudson County rents go up at 3% a year. That's going to make the rent go up each year. It's going to cut into the cost. You're still going to spend $97,000 more in renting. But how about appreciation on the home? In Hudson County, 5.69%, you would gain $517,000 in appreciation. And wait a minute, the best kept secret in the mortgage business is the amortization. You see, when you take a look at principal and interest, we all know interest goes to who? Goes to the lender. But who does principal go to? I mean, think about it. Who does principal go to? It's your own money as a borrower. You are giving it to the lender to hold for you in a forced savings account. Why do virtually none of you talk to your customer about that? It's insane. Because guaranteed and tax-free, it amounts to, in this particular example, $74,000. Guaranteed and tax-free. Add your tax benefit to it, and what would be the benefit of buying versus selling? Would it surprise you if I told you it's $451,000? $451,000, and that includes the cost to sell the home. A real estate commission of $73,000 is included. And remember, we took into consideration the repairs and all the other stuff. Well, that's a 7% rate. Now, some of you might say, well, what if they're not there for 10 years? What if they're there for 5 years? Here, at 5 years, it's still $152,000 better. Sorry, guys, you were going to say something.
No, I was just going to say, and yeah, and you did that at 7%, not even the 5 1/8 that Tom's
5 1/8. It's ridiculous. Here, we could change it to 5 1/8 here. Okay, here we don't have to be that generous. Say 6%. Boom. You could see it's $172,000 over 5 years. Over 10 years, you know, it's $492,000 at 5 1/8. Okay, I mean, guys, this is so important that you understand that A, you be creating wealth for your borrower. You're making them happy. You're acting as an advisor, and you're probably setting up the refinance down the road. B, what you're doing is you're helping that real estate agent and everyone in their office. And folks, this is a reason for you to go ahead and do a lunch and learn seminar in that realtor's office. And by the way, this is what you're going to send to the listing agent too. Nobody markets to the listing agent, but what if you say, hey, Mr. and Miss Listing Agent, we help that buyer see the value and opportunity in purchasing that home that you're selling. Let me show you what we sent them. Would you want me to do this for your customers too? Let's co-brand with me and do this together.
Okay, that's an awesome scenario. Clearly, even if there was some rate objection, using this tool would certainly help to open the eyes of the potential buyer. Should we go to the next scenario, guys? I know we're a little tight on time today, so should we go to the
Please.
next scenario, Tom?
Yeah,
Okay,
let's
Tom,
do it.
I'm going to hand the ball back to you, Tom. So
You betcha.
I like being the guy in control of the screens. Yeah. All right, take it away, my friend.
Are we good to go? Okay. So here's the next one. Non-QM also does include borrowers that have had some credit issues, a credit event. And so here's a borrower. They had major health issues. They had extensive credit problems, filed a bankruptcy, Chapter 7 in 2014, and 2 years later actually had to give up their house through foreclosure. So somebody who tried to keep the house going but just couldn't do it. But when we closed this loan, this was less than 2 years, and that's kind of a hurdle that I'll show you in just a second. The FICOs that we still saw on that borrower, though, were in the high 600s. So they kind of started to repair their credit since their foreclosure, had some things open, and we're doing a good job paying that. So again, I'll just read a little bit more. We have a non-prime program. We got them an 80% loan. And this is important because one thing that really matters in the non-QM space for Angel Oak is that these borrowers have to have an ability to repay. And one of the strongest points of this loan was the fact that the borrower's new mortgage payment was going to be slightly more than the rent they had been paying since their foreclosure. So, we're looking at these loans manually. We're looking at their ability to pay their rent. If they can pay their rent, their mortgage payment's not changing a lot. That's the kind of loans that we want to do. So we've got the scenario here. I'll just take it back to our quick quote. That borrower, we had a 680 credit score. What was our loan amount? 280. So there's the category there. Our LTV was 80% purchase, and that was a full doc. So that was fully documented, and their housing history. So we had a foreclosure greater than 12 months, but less than 24 months. So you select that, and here's the scenario that pops up. It's our non-prime product. Again, doesn't mean anything to you, but this helps us categorize it. It says housing event seasoning, as long as we're outside of 12 months, this is the loan for that borrower. And you can see the rate 7 and 8.
Tom.
Yeah.
Where was this one at? But
Tom, before we do that, that's right. I'll pick. We're gonna move it around the country, so I'm just gonna pick different places. It won't matter. So let me ask you this, Tom. Question for you. There's no mortgage insurance. Are there any points?
Just lender points. So I'm gonna put origination.
I'll put 2 points in there. I'll put 2 points in there. Okay.
Yeah.
Okay.
Absolutely.
All right. So I am ready when you are to send it back to me. I've already kind of saved this loan, and I want to show you something here. Let's set up a scenario, Tom, while Frank is doing that. He's sending me back the screen. I'm going to show it to you. You should see it. So here we go. Here's what I wanted to do. I wanted to go to different parts of the country. Look, we went to New Jersey. Let's go kind of across the middle of the country. We'll move further west as we go along here. But for Angel Oak, let's assume a $350,000 purchase price. Let's go to Tennessee, okay? And let's go right outside of Nashville to Williamson County in Tennessee. We know the taxes. We know the insurance. We put that in there. But here's the thing what we want to try and do. What if that customer were to say, hey, you know what, that rate of I think the rate that you 7 and 8. So let's go ahead and let's put that in there. I'm just going to edit this for a minute here. At 7.125% is the rate. Somebody might say, you know what, I'm going to wait because you know what, Tom, I had this foreclosure. And I don't think that I should move forward at 7 and 1/8 now. I think it's better for me to wait a little bit of time and clean up my credit, and then I'll go ahead and I'll apply and I'll get the best rates that are available, right? So here's what we have to understand. While they're trying to do this, the world is not standing still. So we want to try to do is illustrate to them the cost of waiting. So I put that loan in there, 7 and 1/8 with a down payment of 20%. We had an 80 LTV on a 350 purchase, right? 350 purchase, 80 LTV is $70,000 down payment, no MI. I put something in there for points and closing costs, and it's a 30-year fixed transaction. So updated that, And now let's take a look at the cost of waiting on this transaction. So the first thing that we have to do is we have to take a look and we have to say, okay, if they wait 6 months, according to the National Association of Realtors, in 6 months from now, the rate that they would be looking at would be 5.5% just 6 months from now. Okay, that's what I'm sorry, 5.25% 6 months from now. That's according to the National Mortgage Bankers Association. Pardon me. If they waited a year, it would be 5.75 is their rate that they'd be forecasting. So this is assuming that they cleaned up their credit. And if we waited 2 years from now, it would be at 6%, which I'm putting in all of the forecasts from the Mortgage Bankers Association. And if they waited 3 years from now, it would be at 6.5%. Those are their forecasts. So now that we've done that, let's take a look and let's go with the cost of waiting. And as you can see here, on a purchase price of $350 today, if they waited just 6 months, the forecasted appreciation, we went with something modest here, okay? That's why I wanted to go to different parts of the country. If we went with something modest, the value would go up 1.11%. In 1 year, 2%, 2 years, 5%, 3 years, 10%. So as you can see, that value of that home is increasing. And at the same time, the loan amount would have to go up to keep the same LTV. Now, what they're going to see here is that while their payment, if they were able to make all the adjustments to their credit, would put them in the best interest rate environment possible, in 6 months, if they were able to do it, they probably won't be able to do it. The rate's going to be 5.25. Realistically, if they waited 1 or 2 years, their rate's going to be up there anyway. So what would be the benefit of them waiting? So let's take a look together. If it would take them 1 or 2 years to do this, then it's true. In the monthly savings, they could save $200 a month if they were to be able to fix their credit up in that time. But they would have lost in appreciation and amortization $10,000. It's not worth it to save $10,000 to save $200 a month. And if they waited 2 years, because that's probably how long it would take to fix up their credit, yes, it's true, you'd save $105 a month. But it'd cost you $25,000 between appreciation and amortization. And you know what? If you waited 3 years because it just took you a long time to fix up your credit, not only would it cost you, not save you money, it would cost you $91 a month, and you would have lost $46,000 in opportunity. Clearly, it's better to do it today. And that's the point we want to emphasize, because you can see the appreciation gain and you could see the savings gain and how much equity you would have received. So
hey,
this is just
Barry, if I could,
yes.
those are extremely conservative appreciation numbers that you have in there too.
100%
over 2 years.
Exactly. And that's why I wanted to show that. We're not trying to say, hey, you know, these are outstanding rates. I mean, look, there are some parts. That's why I tried to pick someplace really conservative. You know, if I went to California and if I said, okay, let's go to somewhere like Contra Costa County, Northern California, and we did the same thing. Now, you can't find a home for $350 that easily there, but just to give you a point of reference on this, if you were to do something like this and say the cost of waiting, I'd like to see it. I mean, you can see that it actually, if you waited just 6 months, believe it or not, it would cost you $104 a month more if you waited just 6 months. You know, it would cost you $210 a month more if you waited just 1 year. So these are the areas where because of appreciation, you have to borrow more money. So this is the things we have to kind of explain to our customers is while they're shopping, the world is changing. And we have to focus not on the small difference in, or what some might consider even a big difference in rate. We have to focus on the bigger picture, which is the opportunity you're getting in appreciation and amortization in making the purchase of this home. And by the way, that does not include any tax benefit, because tax benefits are, you know, they're not going to be as great as people think. So we've really not even included that in this analysis here. But what you have to focus on, folks, is that, you know, in any of your scenarios, I mean, look, imagine if somebody's beating you by an eighth in rate, okay? If you can't turn them around and focus them on the big picture here, that's the wrong way to focus your customer. Because look, every person out there knows that 4 3/4 is cheaper than 4 7/8. Everybody knows that. But when you break down what is the actual cash difference in monthly payment and what would be the cost in waiting, you know, that $15 a month or $20 a month that they're focused on. They should be focused on the tens or hundreds of thousands of dollars and focused on the benefit that they're going to be receiving long term and getting into this opportunity. And Angel Oak helps you do that and turn nothing into gold for yourself, your customer, and your realtor.
Very true.
Awesome, man. This tool is pretty amazing that you guys put together over there at MBS, Barry.
Well, thanks, man.
It's pretty
Thanks,
slick.
man.
I mean, the fact that you got the whole freaking country in there and every single county in there, and you've got all that
Yeah,
stuff
you
at
know,
your
you
fingertips.
could actually we could do a real estate report card here, and I know all the individuals at Angel Oak have access to this, that they can share some of these tools with you. You know, you could go to any state that you like. You know, you want to go to anywhere in the country. I mean, certainly if you were in, you know, you're in New York, if you're listening to this, and you pick whatever county you want to put. You know, I'm born and raised in Brooklyn, New York, in King County. So if you want to get a report card for that, you could see exactly where it stacks up, what the forecasted appreciation is, the median home price, how much you would gain in just 5 years, what the job market looks like there. I mean, this is great stuff that Angel Oak will show you. You can export out and you can share it in English or in Spanish and co-brand it with your real estate agent so that you can now send out this amazing piece and use it for social media as well. It's a very, very great way to be their advisor instead of just a loan originator or a salesperson. And then, of course, this allows you to go right to the listing agent too. So
Nice. Great stuff, man. What do you say we dive into the third scenario? You guys good with
yeah,
that? All right.
Yeah, let's do it.
All right, take it away, Tom.
Okay, I got it. So yeah, our last scenario here is just we had a borrower had a foreclosure just over 4 years ago. They have a 704 FICO, and they came to us for a jumbo loan, a $612,000 loan, and the request was for a 90% LTV. So we go right back to our quick quote. We use that scenario. I think we were just over a 700 credit score. Our loan amount was 612. This time we're asking for a 90% loan to value and no 30-day late. So our platinum program, here's the 90% for this borrower, 5.99 with no MI. And that's what we were able to get this borrower into. Minimal down payment, no mortgage insurance on a jumbo loan.
Wow.
4 years out of a bankruptcy. Excuse me.
what was the purchase price?
That would be roughly 700, 690. I guess
Right.
if I could do that math fast enough in my
Yeah,
head.
that's fine. That's fine. And it's a 90 LTV, right?
Yes, you got it.
Got it. Okay.
All right, let's see the magic. Are you ready, Barry?
Yeah. So in this particular scenario, we want to just show them because the rate on this shouldn't be that much of an issue. Let's get them focused on the opportunity ahead. So I went with a gained and appreciation tool that you can utilize. So here we see that $700,000 value, 630 FICO. You're in California, Orange County. We're moving west, okay? We're going to take a look over the next 7 years what this looks like. We know what the historical appreciation is. We know what the forecasted appreciation is. This is based on the last 43 years, by the way. We've got the forecasted appreciation for the next 7 years. As I said, 630 loan, 30-year fixed rate. I know it's 5.99. I even put 6% in there just to make it easy. Let's take a look at what this shows you. So when we show the results here, we could see that in Orange County, California, where this particular transaction was, here's what the home would appreciate to. You would gain $287,000, but you'd also amortize that loan down from 630 to 566, giving you an extra 63,000. You'd have $351,000 gain between appreciation and amortization, and then you'd also have your down payment of $70,000 for a total of $421,000 7 years from now. Hey, you want to know how you're going to get your kid through college? You want to know how you're going to shim up your retirement? You want to know how you can pay for that second home? You want to know how much down payment you're going to have for your next property? Here you go. Buy this home. Yes, the rate's slightly higher, but this is something you need to consider. And this is based on historical. The numbers are pretty darn close. So you can see 43 years worth of history will bring you to roughly the same place. These are things that an advisor does. This is what helps. Look, here's what we know. When somebody shops for a home, they shop visually. You shop with your eyes, okay? They start off online shopping. Then if they go and see the home, they become emotionally attached if they like it, so it's a matter of the heart. But the decision to buy is a financial one. It's done with their wallet or pocketbook. And you know what's crazy? Realtors do not sell that way. Look at any multiple listing description. It's always the amazing hardwood floors, the granite countertops, the spacious closets, the quality and proximity to schools. And mortgage professionals are not that different. How does a mortgage professional sell? Hey, I'll get you approved. I'll get you approved on time, get you closed on time. Great service, fight for the lowest rate. Everything that people say there is important. But remember, the decision to buy is a financial decision. It's done with their wallet or pocketbook. This sells to their wallet or pocketbook. And Angel Oak makes it possible by putting them in this home and allowing them the opportunity, because the alternative is zero. The alternative is I lose all of this. I don't get this. Okay, great. I didn't spend 5.9 on the rate, but that means I missed out on $351,000. Isn't it foolish not to look at that? I mean, this is what we have to focus our customer on, is the opportunity. That's how they buy. Sell to them the way that your customer purchases the home. And then, look, I want to show you another quick tool here, if I may. It's a refinance tool. So let's just say if somebody were saying to you, look, okay, I'm going to buy that home, $700,000, right? And I am in right now, we have them in your office right now, May of 2018. And using the same example, they're in California and they're in Orange County. So thanks to the folks at Angel Oak, thanks to Tom's team, you got this thing done. But the customer is saying to you, you know what, man, think of it is I know I did this loan with you, and I know you got me in the home, and I know it's great, okay? But the fact of the matter is, if I get to an 80 LTV and I do a little bit better work on either my returns or my credit, I can probably refinance to a conventional loan. And look, Tom, you have no hard feelings on that. If they want to do that, that's fine with you guys, right?
Absolutely.
So if the interest rate in the future, I mean, the rate that you got today, let's just say a rate of 7%, okay? I'm sorry, 6% you used in this example, Tom, 5.99?
That's correct.
No MI, right?
Correct.
Now, your target is going to be an 80 LTV. You can put any target you want here. When will I hit an 80 LTV? The good news is you could tell them, you see, because you can see the appreciation of that home. At the same time, you could see the amortization of that loan. And here, that gold line is the target 80 LTV. You're going to hit that in November of 2020. That's not that far off. You're talking about 2.5 years. And if the customer said, hey, what if I accelerated payments? I can pay $200 a week. Okay, that's $860 a month. That's 4.3 weeks in a month. You can get that refinance done in May of 2020, in 2 years. You're going to start payments if you close today in July. So that's 1 year and 10 months worth of payments at the higher interest rate. Let's set up an appointment, put it in your Outlook calendar and do it. And then if you're able to do, I mean, the great thing about this is you could take a look and you could even see all the history. If you want to see what the history was from the 90s, you could see what that property value would have done and what it would be worth. Or if you said, hey, if we did the scenario with Tom 2 years ago, because Tom said, hey, we can let's say Tom gave you the opportunity of this 2 years ago. You could see what the value of the home went up to. You could see now you'd be in that position to refinance. And if you went from 6% to, let's just say, if the rate in the future were even 5.5% or even 5.25%, let's say 5.5%, you can see that you'd save them $274 a month. And then, so here's the thing that we want to try to always do is explain not just the savings, I'm sorry, $291 a month, not just the savings, but show them, hey, when you refinance, what if you kept the payment the same you were making now? You'd have that loan paid off in 25 years instead of 28. You'd save $125,000 in interest, and you would be gaining a net worth $185,000. Make the same payment you're making now on the new refinance, and here's how it works. It just amortizes right down the schedule. So by you doing the initial loan with Angel Oak, you're in a position now where 18 years from now, when your newborn is ready to go to college, you've got an extra $106,000. In 24 years from now or 25 years, you've got an extra $185,000 towards your retirement. The key is get them in that first loan. That's the key.
Awesome. Absolutely freaking awesome stuff, guys. There's our 3 scenarios, and just in kind of a little quick wrap up, I think everybody on the call can see that, well, number one, two things. Two things is okay. I think it's a good idea to go out and chase down some of this non-QM business. And if you stay tuned to us, guys, and if you reach out to Angel Oak, their account reps will help you with marketing materials and help you understand where you can go find this type of business. In fact, I think we're going to have a webinar coming up with Angel Oak again, where we're going to really focus in on finding this business, because it's out there. It's all over the place. So there's a whole new market of business you go to that you can go for that's going to increase your pipeline right away. And it's not that hard to pick this business up, guys. You just got to know where to look. But again, your Angel Oak account executive can help you with that. And the second thing about this whole presentation is clearly the MBS Highway tools that the Angel Oak account reps have that they can help you with right off the bat. But the MBS Highway tool, clearly a wonderful tool to have with your to add into your profession and start using on a regular basis.
And listen, don't be afraid. Don't have the objection in your own mind. Be open-minded to it. Don't focus on exactly what the difference might be in rate. That's part of the equation. Don't ignore it, but also don't ignore the opportunity in real estate, and don't ignore in your own market where you are that appreciation, that amortization. If there's a tax benefit, take all the factors into play. Take into consideration rents going up as well. Once you complete the picture, then as an advisor, you can give the analysis. Okay, that's really what we're trying to explain. The purpose of this whole call here is, look, Angel Oak, these guys are awesome. You should definitely work with them, and I think they can help you. I hope that you guys consider MBS Highway if you're not already on it as well, because I think we can help you too. But most importantly, Frank put this thing together. Really, we all did, to help you not be intimidated if the rates go up a little bit, to not be in the same trap as a lot of people are where they're focused on rates. Really be an advisor and look at everything, and then in total give your analysis, not just one thing at a time.
Awesome stuff. So just so you guys know too as well, the webinar indeed was recorded. You'll be getting the recorded webinar sent to you. Tom's going to send his scenario. Or Tom, are you sending the scenarios or with for this webinar?
Yeah, we sure are. Absolutely.
Okay, so you'll be getting information on Angel Oak, and of course MBS Highway, where there'll be an offer in there for you guys to get MBS.
And by the way, Frank, I really think what's really critical that you do is I think that, I've seen Pre-App 1003 and I've seen Listing Booster and I've seen how it works. We have a lot of clients that swear by it. You should put a link in for that, because I think what will happen is that they could see how powerful it would be to get those Pre-App 1003s and to use Listing Booster to generate leads on this stuff. Boy, let me tell you something. Show this to people on the listing side, by the way. Explain to them that you have a home for not just the A borrowers, but by working with you, those listing agents, they can take into account a much larger range of potential buyers. And if they do that, that does nothing but help the selling price. It'll sell more quickly at a higher value.
Yeah. Awesome, man. Well, this has all been great. I know, Barry, you've got to get going. I know that you're right at your time to leave. So if you want, you can go ahead and do your thing. Me and Tom will just go through. There's a few questions in here. There's really not a whole lot of questions, but there are some questions on the loan, on the products, on Tom's products. So maybe we could field a couple of those questions real quick. And if we miss your questions, guys, don't worry. Angel Oak or Barry's office will reach directly out to you and answer them for you.
For sure. All right. Be well, everyone. Thank you.
All right, Barry. Thanks for everything.
Thanks, Barry.
Okay, I'm going to go ahead and bring the ball back to you, Tom. Well, I'll bring it over to me. I'll just bring it over to you, Tom. Maybe you can go back to the original screen on your presentation while we just field some questions.
Sure.
Or you might even have to jump into your quick quote or something like that for some of these questions. So let me hand that back to you. So you're ready to roll.
We can do anything, all the above.
Well, you know what? I think based on what I'm seeing in the questions, most of these they're just little questions that the AEs can answer. But one of the big questions that's popping up, and I think I saw your screen, and we do have, if we could just take 10 minutes, Tom, to go over where to find the business. I saw that screen pop up temporarily.
Oh, yeah, sure.
I think that would be, this right here, guys, I think is a really valuable 10 minutes, because just to let me tee this up, Tom, and you take it away. But listen, guys, you get connected to Angel Oak. It's easy to do. You go to the website, you apply to get connected. It's going to take just a little bit of, real fast, you'll be connected. Then you can get inside and get a bunch of marketing materials branded to you. So now you've got these marketing materials in your hands. Now let's talk about where we go with them to find this business. So Tom, take it away. And I'll jump in with you here from on point to point here. But let's start talking about how to find this non-QM business. Go for it.
Yeah, sure. Because we get asked that all the time, obviously, Frank. Where are these borrowers, and are they only in certain areas? And it's, the question is, or the answer is really simple. They're everywhere. I love to share, Barry was showing a lot of numbers and things like that, but a number that I love to share with people is that a half of FICO scores in America, in the entire United States, fall below 680, and a third fall below 620. So, you're talking about half the population falls under that 680 credit score, and that's a lot of people. And so if you've only been offering agency and government loans, you've really been restricted over the last handful of years in lack of ability to have some flexibility for borrowers. And we're not saying that everyone below a 680 or below a 620 deserves a loan, but I can assure you there are hundreds of thousands and millions of borrowers in those categories that actually do have the ability to repay and would be good homeowners and good borrowers. So, that's the message that you're taking to your referral sources. I mean, realtors love this. We have example after example of local loan officers contacting our local account executives and going with them and making presentations in front of a group of realtors. How that is so effective. That's so powerful. It's a way to differentiate yourself as an originator, that you can close loans and you have more tools to close loans than just the standard Fannie, Freddie, FHA that everyone else offers. Turn down.
What I think you're going to find at these, if you can get in and do presentation for realtors, and just keep this in mind, guys, is real estate agents are absolutely one of your best targets for non-QM business for themselves personally.
Yeah.
So, because they're self-employed, they're writing everything off. They got a wacky, everything about them is wacky as far as their income is concerned and all that kind of stuff. They've probably had issues in the past. Most agents are not the super ultra successful, making $1 million a year agents. A lot of them are, making, $100,000, or something like that. And it's self-employed, so they don't show any income. And these are the people that want to go buy homes, but they themselves know, and they're kind of maybe a little embarrassed, to kind of go, I really can't do an FHA, or, but if you're in there and you're doing these presentations, you're showing what's available, I'll bet you that you get some realtors themselves saying, hey, I think I need that deal. I want to buy a house, or I'm trying to buy this place. I think I can make that work for me. So just keep that in mind as well. Not only do they have clients, but they themselves could probably use these products. So just something to keep in mind.
Yep. And I'm just going to switch real quick just to show you how on our website, find an AE. So those that are on the phone that don't have an AE with Angel Oak can simply go to this nice, pretty map. You can click on any state, wherever you're located. And when you do that, our team of AEs are going to pop up and you can reach out directly and find that AE. The other piece, if you are approved with us, is, Frank continues to mention the marketing materials that we'll provide to you. But as an approved broker, you have access to lots and lots of marketing materials. And so once you're approved with us, you get a username and password. You can log on here and right here. How about flyers? Just something as simple as flyers. You want to go talk about bank statement potential borrowers to your realtors. These are flyers that say nothing about Angel Oak on them. You would put your logo in here. It's got some highlights about the product, puts your information, your contact information, and this flyer is yours. You can email it. You can put it on social media. You can print it. However you want to distribute it, it's yours. So there's lots of advantages to being signed up with Angel Oak. We're going to help you. We're going to provide to you as many tools as possible to help you capture this non-QM business.
Awesome. Love it. Love it. Can we go back to the where to find business screen again?
Oh yeah, absolutely. Sorry, I keep leaving that, don't I?
Yeah. So, and we just touched on realtors, right? Unless I missed something here. So we just touched on realtors. obviously, looking at any turn downs that you had, you might be able to dig something up there. Builders and developers, I think that goes without saying. Going in there, builder wants to sell a deal. If they got a borrower who doesn't qualify for a QM or government deal, obviously,
Right.
if they know they can reach out to you, that would be great. Accountants and CPAs, again, just walking in there, they run into these scenarios all the time where somebody needs to refi, that type of a thing.
Well, the accountants,
where they might not be able to get
Frank,
done.
accountants are the ones that are doing these tax returns. So they know the borrowers
Right.
who have an extremely good cash flow, but they're good at what they do. So they have a large amount of write-offs that they file for these borrowers. So that's a great resource, accountants and CPAs.
Yeah, and of course, financial planners, and then of course, bankruptcy attorneys. I mean, these guys for sure.
Right.
Here's another one: divorce attorneys. There's always situations there where it's unfortunate, but there's situations there where you might fall into a non-QM deal.
And Frank, you and I have talked about too. There's another source that we don't even have listed here, and that's other loan officers at some of the big banks or credit unions. A lot of those entities are choosing not to be in the non-QM space. So you could call on those loan officers and say, hey, instead of turning your borrowers away, potential borrowers, send them to me. I'll get them in the house that they want, and then turn them back over to you after that transaction. A lot of opportunity there.
Yeah, in fact, that was what I was I'm glad you brought that up, because I was going to kind of move that direction. Because guys, if you think about it, I mean, right here where I'm located in Vacaville, I can literally walk. I can walk to 3 different banks. I have a Bank of the West, I have a First Northern Bank, and a U.S. Bank, all within walking distance of me, that all do mortgages. I also have a Travis Federal Credit Union. They all do mortgages. They're all asking for to their customers to do mortgages with them, and I guarantee you, not one of them will do a non-QM deal. So if I go in there and I work over those LOs once a week, just visit them. How's it going, man? Just keep me in mind. Anything you can't handle, man. I'd love to take care of you and talk you up and keep you in the loop and all that kind of stuff. I bet you can get some business out of them, because they're going to have to turn down deals all the time, because they are strictly, these little banks, these little credit unions, they are strictly Fannie Freddie, FHA, VA. In fact, a lot of them aren't even FHA, VA. They're just Fannie Freddie.
You're right.
Is what they are. So yeah, there's that. So hey, with that, again, guys, we're going to reach out to you guys with everything from the webinar, the recorded version, how to contact everybody, some good stuff for you, access to Angel Oak, access to MBS, access to us and our products, and we'll go from there. I think this was a good webinar, a great webinar, and I hope you guys got a lot out of it. And stay tuned to get something in an email from us. If you don't get it today, you'll have it first thing tomorrow morning. But I would take this stuff, guys, and run with it. I would just take it and run with it.
And probably another thing, Frank, if you did submit a question and we didn't have a lot of time, don't want to keep people past 2 o'clock. So if you did not get an answer, we'll get those questions and we'll get somebody back with you, both Barry and myself. So thanks.
That's right. And there are a few questions out there. The AEs will get a hold of you guys and help you out with those deals. All right, Tom. Thanks so much, man. I appreciate it. And we will catch up with you later. Thanks again. See y'all later, guys.
Thank you, Frank. Thanks, everybody.
Bye-bye.
Bye.